Jeff. Appreciate it. Thank you. Well, I'm excited to meet you guys. Like Jeff was saying, I'll tell you a little bit of my backstory. So I grew up here in Edmonds, and after high school, I didn't know what I wanted to do specifically. I just knew that I wasn't that great at school. So I decided to join the Navy and go off and wear the country's uniform for a few years. When I signed up for the Navy, they gave me a signing bonus. It was $10,000. It was the most money I'd ever had in my whole life. And I was really excited about it. And people were telling me, oh, you should go buy a car. You should go, have fun with it. But I went to my dad and I said, Dad, I want to do something smart with this money. What should I do? And he said, you need to go sit down with the folks at Comprehensive Wealth Management, and they'll explain to you about saving and investing. My dad was a Boeing guy, so he had a pension his whole life, or, he's got a pension in retirement. And my mom was a house, wife, and she didn't work. So she didn't know anything about investing. So money discussions were never a part of my life growing up. And I had never heard of this idea of saving and investing. People talk to me all the time about saving money. So as a kid, I thought, oh, well, then I'll just put my money in a savings account because I'm saving money. But nobody ever taught me that second piece about the investing part. And when I came here and sat down with Gary Arford, the founder of the firm, and he talked to me about saving and investing and long-term growth and making regular contributions to a portfolio and being intentional with your money, it was life-changing, to be honest. I was 22 years old at the time, and it changed my perspective on how I treat money. And my wife and I now do this together. I think it's important, if you're married, to do this together, so one spouse isn't trying to drag the other one to do it, because that's how you get into fights, right? But anyways, after I left that conversation with Gary, I told my fiance and my wife now that, number one, I was upset that nobody had ever explained this to me in school or growing up. Nobody ever taught me this stuff. And number two, I thought, this is how I can help people change their lives. This is what I can do to help people. So fast forward to 2012, I get hired on here at CWM, and I keep kind of pushing for this idea of we need to help younger people. There's a ton of younger people out there, professionals that want to be able to do this, but account minimums are so high that we end up just working with people that are in their 50s and 60s and about to retire. So this Starting Strong program is really designed for the younger professional who's in the accumulation phase of life. And it's a saving strategy. It's somebody who working with a coach and a mentor and a cheerleader to kind of see what it is that you're trying to do. How can I help you get there? And what roadblocks are you running into? And how can we overcome them together? So that's the whole story behind the Starting Strong program. I mentioned it in my presentation here, but if you have additional questions or you want to talk, I'm happy to. In the meantime, I will take you guys through a fun little presentation here about starting to invest. So what does it look like if you want to, which screen are you guys seeing? My full PowerPoint? All right. I've got two screens and I never know which one is going to show up when I share my screen. So I'm going to take you through the idea of buying stocks, what to look for when you're starting to invest. And I don't know how many of you here have already opened up investment accounts and are already investing. Hopefully this adds a little bit more nuance to that discussion. So real quick about us here at CWM, this is our team. We're located here in Linwood, Washington. We manage about $300 million in total assets, and we offer portfolio management services, financial advising, insurance, and access to wonderful people like everybody on this call, trusted professionals. About me, I already told you I was a crypto in the Navy for 10 years, and I've been working here at CWN for 9. And I really focus on retirement and financial planning and developing this short, medium, and long-term goals. That's where I spend a lot of time. Is what are you trying to do? Maybe not necessarily in retirement, because for somebody who's in their 30s, retirement is a long ways away. So what are you trying to do in the next 5 years? And how can we get you there? I heard this interesting stat about a month ago that about $2.7 million is earned by the average American over their lifetime. And how many people do we know that get to retirement and have, I don't know, $50,000 in their IRA? That's just sad, right? We want to be intentional with our money. We want to be intentional with our savings, and working with somebody can oftentimes help you be intentional in those cases. What I found in the financial planning process is that you go through different phases at different times. When you're just starting out, you're building that real strong foundation. You want to make sure that in the event that something goes wrong, you have an emergency fund. You have that emergency fund or that cash reserve that Jeff was mentioning, specifically for emergencies, but also for opportunities. You know, if we see a situation where home prices do come crashing down and homes are on sale, like we saw back in 2009, 2010, 2011, 2012, wouldn't it be amazing to have cash on the side where you can go and take advantage of those opportunities? So that's what we talk about, is making sure that you're liquid, that you have access to that money that you can get to. We'll also talk about insurance and estate planning and taxes. And if you have significant debt, a lot of people that are in this age group have, you know, student loans and credit cards and auto loans that they're working on trying to get rid of. So we do a debt to income analysis and take a look at what's your DTI, what do lenders like to see when they're looking at DTI, and how can we get you there? So we look at personal financial metrics to make sure that you are an investable asset for lenders. And then the fun stuff, right? The saving and the wealth building. So you've got your strong foundation, then you move on to this part where you're accumulating wealth and you're building a business and you're buying real estate and you're investing in the stock market and you're opening up a SEP IRA or a individual 401k, because now you've got money to put into assets. And then you get to a point where you say, boy, I've got a ton of money. I need to make sure that I don't lose it. So then we add in diversification strategies and asset protection strategies to make sure that you don't lose all this work that you've built. And then you say, I've got more money than I'm ever going to use in my whole life. Now I need to talk about what I do with this money and how I pass it on to the next generation. So obviously the idea behind compound interest is that your money makes money, and you want to make sure that you are putting as much of your money to work in productive assets as possible. So in this scenario here, you've got somebody starting out in year one with $30,000, and all this person is doing is $500 a month into an investment account, earning 7% interest. Over a 30-year period, that $30,000 plus $500 a month and a 7% return gets them up to about $1.5 million. If you were like me and you only knew about a savings account and didn't invest any of it, your portfolio would look a whole lot like this blue line, which is just contributions themselves. And you would have somewhere in the neighborhood of maybe 200,000. So you can see that that's a significant difference over the long run. But in the first couple of years, it's not all that impressive. 5-10 years into it, you're like, this thing really isn't doing a whole lot. But in those later years, that's where you see the real benefit of that compound interest. So just give it time. So, okay, you say, all right, I know enough to know that I need to get started. What do I do? The first thing I do is direct people to one of these online brokerages like TD Ameritrade. We personally use Charles Schwab as our custodian, but there's also Fidelity, there's Vanguard, there's, I think I mentioned TD Ameritrade, there used to be Scottrade, but they're not around anymore. But I would say to go to one of these websites and open an account. And opening an account with an online brokerage, they need the exact same information that you need to open up a bank account. They need your name, date of birth, social security number. You need to verify that you're not a terrorist. So it goes through the US Patriot Act, protocol. But essentially, they're just going to verify that you're able to open up an investment account. One question I get a lot is for people that weren't born here in the United States, are they able to open up an investment account? And the answer is yes. You just open up a international account. If you don't have your US citizenship, you can still open up an investment account. It's just one designed for non-US citizens. But you must be 18 or have a guardian on the account. So for instance, I have a 17-year-old son who got his first job last year, and he wants to put money into a Roth IRA. And I say, awesome, let's do that. So I open up a Roth IRA for him. It's his Roth, but I'm just the custodian on it. And we're able to fund an account for him. We also opened up a brokerage account for him when he was 8 years old. And for Christmas, I gave him 1 share of Disney stock. And every time he got Christmas money or money for good grades or whatever, he would put money into the account and I would match it. And we would look at what stocks are out there that he was interested in. So for instance, he played Minecraft. So we went and looked and found out that Minecraft was owned by Microsoft. So we bought a share of Microsoft in his account. And then he started to subscribe to Spotify. So I said, well, Jonah, if you're subscribing to Spotify, I'll bet you other people are. So we went and bought a share of Spotify in his account. And just as he was going through life and doing his own things, I would bring the conversation back to how do you take advantage of this opportunity? So eventually he got enough money in that investment account to buy his first car when he was 16. So it worked out real well. So what you will do when you're opening the account, I'm sure you already know this from your experience with the banks, but when you open up a bank account, that account can either be owned directly by you or it can be owned by 2 people, like a joint checking account. This would be a joint investment account. It can be a trust account. So if you have a living trust set up for asset protection, you can open up this trust account at the brokerage. Or you can open up a retirement account like an IRA or Roth IRA. So that decision is made when you are opening the account, and you'll need different paperwork for each of those accounts. One thing that isn't in here that I forgot to add was you will want to link this account to your checking account or your savings account. So you use this. At Schwab, we have a money link. It's basically an ACH form that allows you to transfer money between your bank account and your investment account. That way, every time you get a paycheck or you have a lump of money in your bank account that you want to invest, you can just go to your bank and push the money, or you can go to your investment account and pull the money into the account to fund the account. And then all of a sudden you can go in and invest the funds. So I put this together. A lot of questions I get are, what kind of account should I be using? And that question is really where you are at in the race towards financial independence. If you're just getting started, I want to make sure that you're not investing money if you have a ton of debt out there. So I want to make sure that you're paying off the debt or getting a handle on your debt first before putting money into the stock market, because the stock market is meant for long-term growth. If you're talking about building up an emergency fund, I want to make sure that you have money in either a bank account or a high yield savings account. Get a little bit more yield over and above what the bank has. But then once your emergency fund is in place, then we start talking about that brokerage account or a Roth or even a health savings account. If you have access to an HSA, I love them. They're sorry, can you hear me?
Yes, we can now.
Cool. So the HSA is probably the most powerful account type in America. You can put money in to the account and get a tax deduction. The money can be invested and grows tax-free. And if you take the money out later on, it is tax-free on the way out if it's used for health-related expenses. It's the only account in America that has those three benefits to it. Then usually,
sorry, Mark, can I interrupt real quick?
Yeah, go for it.
On the HSA, like you can invest it. What do you mean by that?
So for instance, a lot of times what I see with HSA structures is you open up an HSA with a custodian and they want you to have at least $1,000 or $2,000 in that bucket, but any amounts over and above their minimum required amount can spill over into an investment account. So for instance, I work with HSA Bank and they want me to keep $1,000 just in cash in there, but any amounts over and above $1,000, I can push over to TD Ameritrade and I can invest in anything that is on the TD Ameritrade platform. So stocks, mutual funds, exchange traded funds, anything that's available at TD Ameritrade, I can invest.
Is there a limit on how much you can put in an HSA every year?
That's where they get you, right? Because it's such a powerful account, they don't want people overusing this structure. So they usually limit it to a family contribution rate of 7,000 or 75. I think it's 75.50 this year. So as a family, between my wife and I and my two boys, we can put 75.50 into an HSA. So you can't put a ton in, but it is a very powerful account. And over a 2 or 3 year period, if you're putting money in, then all of a sudden you're starting to see some real growth in that account. So for me, I just put money in and I never take it out.
Cool, thank you.
Yeah, it's a great account. And
oh, so you don't actually have to take it out at the end of the year either? You're not forced to take it out? You can just keep adding more money and more money to it each year?
yeah, only with an HSA. So there's another account type out there called an FSA, a flexible savings account. The money at the end of the year goes back to the company in that account. So if you don't spend it all, that money goes back to the company. But in an HSA, that is your dollars and nobody has a right to claim it if you don't spend it.
Wow, that does sound like a powerful account. Cool, thank you.
That's a great option. So then once you purchase your home, usually what I see in the Starting Strong program is a young couple just starting out in life. Maybe they're currently renting or they want to buy a home in the near future. They want to maybe sell and buy a bigger home. So a big thing that we will often do is strategize around saving for a down payment. So once they save up enough money to buy the home, well, guess what? Chances are they probably used the money that was in their investment account to pay for it. So then we are rebuilding that emergency fund, maybe talking about college savings using Section 529 college savings plan, or maybe even that UTMA account that I had mentioned that I had for my son, just depending on what their concerns are, or what their thought process is. And then once you kind of get a handle on all that, then we start talking about retirement. This is where we say, okay, in the short term, I've got my house, I've got my debt paid off, I've got a good handle on my near and long-term stuff. So now let's really start focusing on planning for retirement. That way, as emergencies and opportunities come up, people are in a really good position. So, okay, you've opened up the brokerage account, you know what type of account you have. Now you want to start investing, and you look at what's out there and get overwhelmed, right? And there are a ton of things out. I found a study that said that there are more investment products out there than there are actual stocks. So if you look at all the different mutual funds and all the different ETFs out there, there are more strategies than there are actual stocks in the market that you can invest in. I tend to like funds a little bit better than individual stocks, simply because there's a lot more volatility with stocks, and you can't really count on who's the CEO? Oh, Howard Marks, the CEO of Starbucks. Remember when he stepped down as CEO? I mean, the stock market, the stock just collapsed because he was no longer the CEO. And if you weren't paying attention to your portfolio, all of a sudden you run the risk of leadership change and that having a significant impact in your overall portfolio. So if you were to buy an individual stock, say you want to buy Tesla or you want to buy Facebook or Netflix or something, you would find the ticker symbol for that company and you would place a buy order for that individual stock. So a stock is individual ownership of a specific company. It's not managed. So Starbucks does not actually care if you own their stock. They're not working for your benefit. They are working for the benefit of the large shareholders. Usually lower costs. There's no specific costs associated with holding this, except unless the custodian charges you a trading fee. You're more susceptible to home runs and strikeouts. Like I said, there's a lot more volatility in individual stock ownership, and the investor chooses the individual investment. So you are in control of your total diversification in that strategy. Whereas with a fund, there's two types of funds out there that you really need to know about: mutual funds and exchange traded funds. So a mutual fund is going to have a manager that's overseeing the strategy. The manager is going to be deciding which investments inside of the fund are purchased. They're going to come into work every day, look at everything that's available and say, let's move more into this company, let's sell out of this company. So having a good manager is important in a mutual fund. An exchange traded fund is going to be leadershipless. Essentially, what they're going to do is they're going to put you in a specific allocation, and it's just always going to be in that allocation. Think of an exchange traded fund that might track the S&P 500 or the Dow Jones or the NASDAQ. It's going to represent and get similar returns to those indexes regardless of what people think. So there's no man behind the steering wheel in those funds, or woman behind the steering wheel. So money invested in more places in these funds, what you find is that they will have fractions of shares all across the spectrum. So if you have $100 to invest in a mutual fund, you will automatically be diversified between hundreds of different stocks with just that $100. It would take you a whole lot more money to get the same kind of diversification that you would if you were just to go buy individual stocks. By doing that, it potentially lowers your overall risk through diversification strategies. And usually what you do with those mutual funds is that you are looking at investing in specific sectors or specific strategies. For instance, say you really like 5G and you want to go invest in companies that are investing in 5G technology. Well, you could go either pick out those individual companies, or you could go find a fund that is investing in 5G technology. Or say you want something that's invested in real estate. You can go find a fund that invests in real estate. So that's the different stocks and bonds. I say both have their purpose, right? I like the yes and solutions usually. Let's do that and some of this. There's different strategies when you're looking at investing. Some people are wanting those home runs. They're looking for growth. So somebody who's looking for this strategy is going to want, what's the next Tesla? What's the next Facebook? What's the next Alibaba? What's the next big thing? When you're looking for these kind of companies, they may not be profitable at the moment. So what you'll do is you'll go to the balance sheet and you might not see that the company is actually earning a profit, because all of the money that's coming into the company is going right back out towards research and development. Maybe it's like Amazon and they're building warehouses all over the country. So every new dollar that comes in is going right back out as an expense. So they're not operating at a profit yet, but it's intentional. It's not the end of the world if these companies don't have profits. Usually they do not pay dividends also, or if they do, it's very low dividend. So you're not investing in these funds for a high paying dividend. So when you look at the income statement of these companies, you're going to want to see increasing revenue, maybe increasing profits, but definitely sales and net income. Those are what you're going to be looking for with these. And on the balance sheet, you're going to want to see increasing property, plants, and equipment, or increasing debt even. It's not the end of the world for these companies to have debt, because they're usually borrowing at very low interest rates and they're putting that money to work for appreciation. As opposed to, erase here, as opposed to if you want to just buy some good blue chip quality companies, think Johnson & Johnson, 3M, Boeing. These are companies that have been profitable for years. They are established. The banking system is in this category here too. So usually these companies have a track record of success and being profitable, and you will likely find that they are paying a dividend. And a dividend is just money that the company pays out to investors either on a quarterly or annual basis. And that's how you get portfolio income, from dividends. On the income statement, what you'll want to see is just steady Eddie, less volatility and more consistent growth, or consistent, even if it's plateaued. If they're paying a dividend and their growth is plateaued, that's okay, because that dividend is the income growth, is the profits. And on the balance sheet, you're going to look for large cash positions to make sure that they have enough to pay the dividends. Other things you'll want to say, look at their assets, and usually steady or decreasing debt. So they're working to pay off their debts because they don't have significant growth potential. And lastly, there are people that just invest for income. So here you're looking at mutual funds and exchange traded funds, and even different products out there. There's a ton of products out there that pay income, like specifically a REIT, a real estate investment trust. That's a fund that invests specifically in real estate. In those cases, you're going to be looking at things like cap rate, yield, cash on cash returns. You guys are in the investment community here, or in the lending community, so these are going to sound really familiar to you. But this is where you would see those rental metrics that you hear about. You want to see a history, sorry, my mousing skills are poor, a history of dividends in those funds as well. So just picking your strategy is important. If you're saying, I need to get those double-digit returns, I want to see 10, 12, 15, 20% returns, you're probably looking at a growth strategy. If you say, I want portfolio income, you're looking at an income strategy. So you're going to be looking at different things depending on what your purpose is. So I've got these two guys here. You guys have probably heard of George Soros and Warren Buffett. Opposite ends of the spectrums on how they acquired wealth, but they both did it through the stock market. George Soros is a technical trader. What he does is he looks for patterns, and he will short different markets. He will look at momentum and indicators, and he'll look at a chart and say, okay, I know what to do based on where this company is in its current economic cycle. And then Warren Buffett says, I want to buy Coca-Cola when I'm 12 years old, and I want to own it for the rest of my life. And Warren Buffett never sells. He simply just buys and buys and buys and buys. And he looks for quality companies. He says he will tell his students to think, what would it be like if you were only to invest in 5 companies over your entire life? So over the entire span of your life, you can only invest in 5 companies. Which companies would those be? So he's looking for really high quality investments. So there's two sides to the coin. You can be successful in both. What I tend to say is the technical analysis will lead you to the fundamental analysis. So you'll look at all the charts and graphs, and you'll find a few that are interesting. And then you go and you do the fundamental analysis on there, where you're looking at the income statement and the balance sheet. And you're saying, is this something that's actually doing what it looks like it's doing? I use this website called FinViz when I'm doing my stock and fund screening. Here's the link down here, finviz.com, and you go to their screener tab, and you can choose between fundamental analysis or technical analysis. And these are all the different metrics that you can look at. You can look at their PE ratio, you can look at their dividends, you can look at their growth, you can look at their float rate, all kinds of stuff. When I do this, I usually want to look at larger companies. So I'm looking at a market cap that is $10 billion or above. I'm looking in this situation, I'm looking at different banks that have positive growth and are paying a dividend of over 4%. So in this case, this screener will give me a list of all the stocks that are currently in that screen. And you can set your screen to however you want. Or if you're looking at different funds, FinViz also allows you to look at all the exchange traded funds that are out there. A little bit less on the metrics. I wasn't too impressed with a lot of these metrics, but I say, I want to give me an exchange traded fund that's selling for under $20 a share, that's paying a dividend of over 3%. And that will give me different funds that are out there. So you can use this screener. You can get lost in this thing. This is a hour's worth of investigation that you can do through here. But that's kind of a way to get started. And I would encourage you to look at funds more than individual stocks, just because I think you'd have more success in the long run having a diversified portfolio rather than individual stocks. That here at any given point, some of your investments could be down and some could be up. It doesn't mean that your diversified portfolio is bad if some are down and some are up. That's usually how it happens. If the market is in a growth cycle and you have international exposure, or if you have income funds, they might be lagging behind. If the S&P is up, 20% for the year, they might be getting, 5 or 6%. It's not the end of the world, because next year it might be a completely different story. This year we're battling inflation and, issues going on with China and Europe and Russia. So commodities are doing really well this year. Whereas if you had told me to get into commodities a year or two ago, I would have laughed at you. So a diversified portfolio is really important, because you don't know who the winner and loser is going to be in any given market. I often tell people to keep a notebook when they're doing this, to remind themselves why they invested in certain products. You could see that, say you go and you buy some stock or some bond or some fund, and it absolutely craters, but you bought it for income. Well, it's still paying that income, even if the price went down. So you may choose to hold it because it's doing what you bought it for. The risk and reward in these investments can oftentimes change depending on different financial and political environments. So keep calm. If you like it as a long-term investment, hold on to it. Don't let the 24-hour news cycle rattle you out of your disciplined investment strategy. And find a good benchmark. A lot of people use the S&P or the NASDAQ or the Dow Jones as their benchmark, but I would remind you that that's a 100% stock portfolio. And that may not be the right benchmark to use, especially if you're not looking for a 100% stock allocation. So being smart with what benchmark you line your portfolio up with is important. The reality is that oftentimes life gets in the way. We go to work every day, we have families, we have, community involvement, and sitting down at the end of the day may not be something that fits into your schedule. If that is the case, then that's where the financial advisor comes in. We work all day, every day, working on portfolios and working with clients on their finances. So you might think about working with an advisor at that point. Even those with the best of intentions have a hard time staying disciplined in their savings, and the energy and effort that's used to maintain your portfolio and build your portfolio can often be difficult. This is a big one. A lot of times investors have an over allocation to cash. That's just the reality. Usually I hear from so many people that they have $100,000 sitting in their bank account, or $250,000 just sitting in their bank account. That's way too much allocation to cash. it's not being productive. And you want to make sure that your dollars are productive. Most investors buy companies or funds that they're familiar with. So that's your bias, is you've heard of Tesla, you've heard of Facebook, you've heard of Netflix. So you go out and you buy those because you're familiar with them. But there's a lot of other options out there that you're not familiar with. And maybe that's where the growth potential is that you miss out on. Fear and emotion oftentimes get in the way. And in the aggregate, the self-investor will usually underperform the benchmark portfolio. So what we have put together is this Starting Strong program. We've put together a well thought out, professionally designed portfolio for our clients, and you work with a financial advisor. So it's kind of a 1-2 punch. You get access to a great portfolio, and you get somebody who acts as a coach or a mentor or a cheerleader who's in your corner and is checking in on you, seeing how you're doing, and talking you through personal finances as long as managing your portfolio as well. Couple value adds that a financial advisor can provide: portfolio construction, tax efficiency, and rebalancing. But it's mostly from the advice and the coaching aspect that I feel is where we really add the most value. Just working with people as they're trying to hit different goals, running into tax questions, running into estate planning questions. We add a lot of value in those conversations. And things that I like to tell my clients, just for encouragement's sake, is progress is better than perfection. You don't have to do this exactly right. You just stick with it. In the long term, this works out. And if you make a couple errors along the way, it's not the end of the world. You just keep with it. Here's a fun quote: "Too many people spend money they don't have to buy things they don't need to impress people they don't like." I was told that was Will Rogers. I actually think it's Edward Norton from Fight Club, but I like the quote anyways. A lot of times we see people overspend. I worked with a guy in the Navy, and he was from Dayton, Ohio, and he was pretty street. He came from the streets, and I asked him, because he had never invested or anything before in his life, and he said, "Where I'm from, we wear our wealth. We don't trust institutions, so we wear our wealth. That's why you see us with the cars and the jewelry and all this stuff that shows people how wealthy we are, because we have to keep it close by." So just a different thought process there. The best time to plant an oak tree was 20 years ago. The second best time is today. I never say it's too late. Start where you're at and do what you can. And time in the market is more important than timing the market. If you're interested in seeing what this looks like for you, and if this is a program you think might be beneficial, or just start the conversation, give me a call. I am always happy to help, and I'd love to meet all of you.
Wow, thanks a lot, Mark. I appreciate it, man. That was awesome. I love that last comment too. Like, the best time to plant an oak tree is 20 years ago, or the next best time is now. It's like everyone's trying to time the market. Is it a good time? Is it a bad time? Or prices up, prices down, that kind of thing. It's just like keep buying and keep buying and keep buying. And then over time, that's the goal. Like you don't want to, short term this at all. You're looking more longer term with the growth over the years.
And especially if you're starting with a smaller account balance and you're putting money in on a regular basis, that's the perfect time for the market to crash, because then you're buying in at lower and lower and lower prices. Yeah. If you've got $1 million and the market crashes and you're looking at retirement in the next 2 or 3 years, well, that's terrible. But if you're young and the market crashes, and say you've got $10,000 and the market goes down 20%, well, you're out $2,000. It's not the end of the world. You can fill that bucket up over the next couple of years, and then you're off to the races.
Sweet. Hey, we got a couple of questions real quick. Mickey Valentine said, can anyone have an HSA, or do you have to have a specific type of health insurance account to be eligible for an HSA?
Yeah, good question. You have to have a high deductible health insurance account through your employer. So those are the two qualifications. It's got to be an employer plan, and it's got to be a high deductible employer plan. What we're seeing these days is there's a lot of networks they can get together. Say there's a network available for real estate agents, and they can all kind of come together and pool their resources and act as a buying or as an employer to get an HSA account. So for self-employed people, it's a little bit more difficult, but if you work for a company that has a high deductible insurance plan, they should have the option to have an HSA.
I wonder if National Association of Realtors would offer something like that to the realtor base that's on here.
I can do a little bit of research and email that over to you, Jeff.
That'd be great. Thank you. Next one is from Sky. Is the S&P an appropriate benchmark if you're buying ETFs? What are the other benchmarks? Do you recommend any one over another?
So the ones that I use personally, if I'm looking at an all stock, like a 100% stock, benchmark is, I think it's, so iShares puts together these different portfolios, and I think it's IOO. Looks like the number 100, and it's a pretty well diversified portfolio. If you're looking at an 80-20 mix, there's a few different ones, and these aren't recommendations. So if you go out and buy these and it goes down, you can't blame me.
They're well diversified is what you're saying. So
yeah, essentially, because the S&P 500 is 500 of the largest companies basically in the world. And sometimes that's appropriate, other times that's not appropriate, right? If you're looking at buying small cap stocks, then the S&P 500 is not the right benchmark. If you're looking at investing in real estate, then don't look at the S&P 500 as a benchmark. But if you're looking at an all stock portfolio, a lot of times it's the S&P 500 that is the benchmark for a 100% stock portfolio.
The next question is, how should we leverage an employee stock purchase plan as part of our investing strategy?
Yeah, stock purchase plans are really slick. So anytime I see an employer benefit, like a stock purchase plan or an employer match or RSUs, the company is basically trying to give you additional value. So I like those. What happens with the stock purchase plan is you usually buy your company stock at a discount. They let you buy, say you're working at Microsoft and they offer a stock purchase plan. You buy the stock at a 5 or 10 or 15% discount within a certain window of opportunity, right? I like them. What happens is if you stay in that stock, you get overexposed to that single company. And especially if that's the company that you work at. So that company is providing your income and that company is providing you portfolio returns. That can end up being a pretty dangerous scenario. So I do encourage you to buy the stock at a discount. Usually we'll talk about whether or not you should keep that stock and maybe whether you should diversify into a better portfolio that's going to reduce your overall risk. But it just depends on your exposure.
Perfect. And then another question from Danny, are there any restrictions to get financial advice from CWM? Meaning, do I need to have a set amount of money or be an accredited investor?
So no on the accredited investor piece. The Starting Strong program, we do open it up to investors who have 100,000. So that's our entry point. We find that we were taking a loss on the work that's involved on the front end to onboard clients if they didn't have 100,000 or above, or 100,000 and below.
Does that include like 401ks, IRAs, stuff like that?
Yeah,
as well?
so that's the whole portfolio. The way we make money is we charge a management fee on our portfolio, 2% on the first 500,000. So if you have $100,000 with us, you would pay $2,000 a year. And management fee, that's the portfolio and the financial advice.
Perfect. And I think a lot of people, if you don't have the $100,000, I mean, where I started investing way back when I kind of learned that I needed to do that, is I actually invested with Schwab, and I would just go into their mutual funds and find, they have a really good tool in there to investigate mutual funds that tells you the risk level they have, you know, the returns over 5 years, 10 years, and things like that. And you can just find some stocks that are really stable with a good return. And or the mutual funds like Marc was, or the ETFs that Marc was talking about, like an S&P 500. It's really simple to get in, and relatively, you know, when you got 500 of the best companies in the country, it's hard to go wrong at some point. They're not all going to go down at the same time, typically. So it's a relatively more safe than not in that case. But of course, we're not giving financial advice on here because I have no clue what I'm talking about.
Yeah, and I tell people, you know, like, people are worried. People will talk about the stock market like it's gambling, but the reality is that if the entire S&P 500 or if the entire stock market went to zero, something significantly bad happened, where all the corporations in the world essentially disappeared. And in that case, you're probably more concerned about survival than your portfolio.
Right, exactly. Like, there's a massive collapse at that point. There's
Right.
no commerce anymore,
Right.
or economy, I think, at that point, right?
Mm-hmm.
So we're in a whole world of different hurt. Anyways, all right, cool, man. Thanks so much.
You
Appreciate
got it.
everyone jumping on today. We did record this, so if anyone wants a recording, we'll be sending it out here once we get it all set up, maybe in the next day or two. It'll also be available on our Facebook page once it's done as well, I believe. So if anyone has questions, you can reach out to Marc directly and or just shoot us an email. We can get you Marc's contact information as well. Otherwise, everyone have a fantastic Tuesday, and thanks again for joining us. Talk to you soon.
Thanks, Jeff.
Bye.
Thanks again, Marc. Appreciate it, man. Go Navy. Go Navy.